Thank you very much. So, first of all, you got tricked because the title is Demystifying Crypto, Everything You Need to Know, and I'm not able to cover everything you need to know in the next 30 minutes. So that was a little bit clickbait. I'm happy that you're all here, and I hope everybody learns at least a little bit during this presentation. One little heads up. So we have a scary thing happening, probably during my talk, and it's not related to taxes. There is the German National Warning Day, and all our phones will go off at some point. I will make a pause. Don't be scared. It's okay. When you have your phone out, let's use that 30-second to 1-minute break to quickly open LinkedIn, and feel free to add me and follow Pikuna, because then you can stay up to date with what's going on in the tech space and keep learning all the things that are important for your personal taxes. So yeah, I'll start with a couple words about me before we really dive into the topic. And I would like also to know a little bit about you. So hands up for all of those who are tax residency in Germany, who are registered and are living in Germany. That's almost all of us. Who's not resident in Germany? Tax residency 2, 4. Would you be okay if I pivot the whole thing to German jurisdiction? You will still learn something, but it is more German specific, and I think the big majority here will get more out of it. So the stretch that I always have to do in the legal area is jurisdictions. International conference, you don't know the audience exactly. Therefore, I'm able to swap a little bit of how much I go into one country-specific area, or how much, if I make it a little broader, and do like general tax concepts that are therefore applicable for multiple jurisdictions. How are we with German speakers? Who here is German speaking? Also, almost. Who's not German speaking? One person. Okay, I'm sticking with English then. That's fine. So yeah, I studied tax law. My career actually started at the tax office. I used to work for them for almost 7 years, but pretty quickly after joining them I realized, okay, doing the classic tax declaration work is not really my thing. I want to do something else, so I swapped into the development department. So I was very early on already in the intersection of computer science, developing code, and taxes and regulatory. Then I learned that's a lot more fun and a lot more of what I want to do, so I started to also do my degree in computer science at the LMU. I'm sorry for all the TU people here. And that's also when I got into touch with Bitcoin for the first time, many years ago at this point. I'm very happy that this happened, and then that was during 2015 when I was working on my degree. And in 2017, I also made quite some good profits, and I was like, okay, now I knew I had to declare it in my tax declaration. It's something that has to do with taxes, but I was not able to do my own tax declaration, and that was really that click moment for me, like, okay, I'm working for the tax office. I have a degree in tax law and in computer science, and I'm not able to do my own tax declaration. What's wrong with that system? So I started researching, reading up things, and that was very early on. There was not a lot of things. There was still discussions in like Bitcoin Forum.de and things where people were guessing how taxation could be handled. So I got very early on in contact with other tax advisors who were working in this field already. There weren't that many, and then the field grew and I got more interested and could build more knowledge. And then I started Pikuna in 2019. And what we are doing is a reporting service. So we're not tax advisors. I never got my tax advisor degree. We are doing cryptocurrency reporting, so the step before the tax declaration, and actually that step is already quite complicated, why it allows us to have a company like Pikuna. On the other hand, to be honest, my company shouldn't exist. It should be easy. I would prefer it to be easy too. There is still enough for me to do, but I'll go a little bit into why it is so complicated and what you can take from me to implement that hopefully into your tax declaration. If you think you want to talk to me as a client, just reach out. If you have any further follow-up tax questions, feel free to reach out as well. I'm able to do this talk in a 10-minute and a 2-day version, so anything in between. I've done it multiple times in German, in English, for national, international audiences, so I'm very confident and happy to discuss any topic. I don't think you can bring up anything that I haven't heard before. I'm working as an advisor for the Ministry of Finance in Germany. I'm working for members of parliament to advise them. I'm very active in the German blockchain constitution group. But let's go into the problem. A lot of people still these days, they're getting less and less, think if you're in crypto, we don't pay taxes. Forget it. I'm not going into all the details. You already heard about Mika and Kaf. Here, 10 years tax avoidance can still be punished. I'm also not going into any details in this area, but just that you know of what time frame you're dealing. And once you get your Lambo, that's also a high risk thing to do, because the tax office will ask, how did you pay for that? And latest then you will need to declare, oh, I made money with crypto, and that's fine, but then they will ask, why didn't you declare that profits you made with crypto? There is a lot of things of getting caught. That's also its own presentation where I just copied that deck. Today we want to more go into the area of income tax. So there's different tax areas. For today we only focus on income tax, Einkommensteuer. And the basic is that makes it so complicated. We have different pots. And I think the symbol of a pot, everything that goes into one pot has one set of rules. Once you're able to distinguish what pots there are and what are the rules for each pot, that makes it kind of easy. And usually mistakes happen when people mismatch these pots or confuse the rules for these different categories or selections. In tax law we call them income classes. So there is the trading, investing, the other income, staking, lending, airdrops. Then in Germany the specific one, we have like margin trading, where we are in the capital income area. We have salaries or business activity. Those are the 5 ones that are really covering almost everything in crypto. Also including the business activity, that's also already a little special, and the capital income, because these two usually do not apply. Mostly we're working in the area of trading, private, privates Veräußerungsgeschäft, and the other income area of staking, lending, airdrop. And I want to take a couple minutes to go into each of them. That's not a German-specific case. For everyone who's not tax residents in Germany, this might not be so relevant. But still, some of the rules might be applicable, or you can at least have a basic idea and then adapt it to your jurisdiction. So for every privates Veräußerungsgeschäft, we need a acquisition and a sell. So these two things kind of go together, and once we have both of them, it's considered a trading activity, and then we need to calculate the income. We have a free amount of 600 euro that was increased to 1,000 euro for the tax year 2023, meaning everything under 600 euro is completely tax-free. It does not mean you can deduct 600 euros from your profits. That's a little bit different than we are used from our work income, where there is this free amount that you can just deduct from any income you get. This is really a crossing. Once you cross these 600 euro, you pay taxes for everything. So 601 euro for in trading would get you 601 euro taxable, not 1 euro. Very important is the 1-year holding period. That is actually a big benefit, and I have lots of clients who moved to Germany for tax regulation reasons for this 1-year period. Everything that you hold for more than 1 year, no matter where you bought it or when you bought it and where you lived when you bought it, this rule applies to you once you're a tax resident in Germany, and the selling occurs while you're tax resident in Germany. I have clients that move from other countries to Germany to sell their crypto while they're here, only to move on later. So we are kind of living in a very fortunate jurisdiction when it comes to crypto trading taxes. We have very good rules, and we have quite good information of what falls under these rules, and even some guidance and clearance about edge cases. It's not perfect, but compared to many other countries, it's really, really good what we already have, and completely tax-free. And we're often talking about millions that are tax-free because they bought super early and then were just holding on, and now they're coming here to sell. To calculate the 1-year holding period, we also need to know account separation and first in, first out. Those two are relevant to know what are the acquisition times and prices. Because oftentimes you have like multiple acquisitions and multiple sellings, and which one is which. If I have multiple Bitcoin on my wallet and now I'm selling one Bitcoin, which one is it? Which one? When did I purchase the one that I'm actually selling right now? Because there is no saying, they're all on one wallet, they're all the same. Therefore, account separation, everything that can be separated shall be separated. So if I sell something on Kraken, my Coinbase holdings are not affected, because if I sell on Kraken, they're obviously not the Coinbase coins that I'm selling. Same with different wallets, same with sub-accounts that some exchanges offer. This rule allows me to really decide which coin exactly I'm selling, because I can move my coins around however I want. So if I say I want to sell the coins that I bought yesterday, but I'm doing dollar cost averaging for the last 2 years, I'm just looking into first in, first out, and move all the old coins into another wallet till I have only those recent ones left, and then I can sell them and I can deduct my losses, for example, or use them for something very specific. So those two rules in combination, account separation and first in, first out, make a big deal into optimizing your taxes. Really figure out which coins are where, and how much are they worth, and how much are they in profit or loss, and then you can move around. Those are taxed with the personal income tax, and the loss deduction is only possible with other trading and only within the 1 year holding. So if you have assets that are worthless at some point for whatever reason, sell them. No matter if you get nothing or 1 cent, sell them. If it's within the 1 year holding period, you at least get your losses back from the taxes. And so other income, basically everything where you're generating new income, staking, lending, airdrops, everything here goes into that pot. It's collecting. Here we have the free amount of 250. It's also personal income tax rate, and this counts as an acquisition. So we learned earlier in the trading it needs an acquisition, but that counts as an acquisition. So that's how the law maker gets around the lack of the acquisition by just saying that's an acquisition as well. Capital income is a little bit different. Here, that's not a German-specific rule. If you're doing anything in the area of margin trading, CFDs, anything that's leveraged, they come under very different names. Futures, be very careful, because there is a so-called Verlustabzugsbeschränkung, and that's with 20,000. So all your gains accumulated and all your losses accumulated, you can only, even if it's in the same year, deduct 20K losses. I have one client who said he's using 80K to trade, lost everything, and at the end of the year he was like, okay, I have a loss of 80K, no worries here, no hard feelings, that was dedicated for trading. But what he was not aware of, that during that almost 1 year period, he like bought and sold and had quite good profits in between, and we ended up with a 220K profit and a 300K loss. 220K profit minus the deductible amount of losses, 20K, makes a 200K profit that the tax office now uses as the taxable profit for margin trading. 25% on that gave him additionally to his 80K loss of his asset another 50K in tax bill. Real case in court right now. For me, it can't be right. It feels wrong, but it's actually the current legal situation. It might get changed in the future, but everybody who's doing margin trading, be really careful. And in Germany, I can only recommend you to stop at this point, because the tax risk is just so high. It's not worth it, and it's a lot of small ups and downs, and usually in margin trading you have big profits and big losses, and they just add up over time. 20K is like losing 20 times 1K. It's not that much if you really think about it. And that can leave you with a big tax bill behind. If you're getting paid in crypto, you've got to tax that as well, as same as your other income in fiat. The business income is sometimes a little bit tricky because there are certain cases where you're falling into business income that you don't want to. So here the tricky part is if you are a business income, then you also have to pay a special Gewerbesteuer, you have other accounting rules, you need to register it, you need to deal with VAT. There's a lot of rules that come on top, so usually you want to avoid that. It can be a benefit if you're having a lot of losses, because here you can unlimited loss deduction and also loss deduct against other incomes. So that's one benefit why people open a trading company where they just trade themselves. Now I want to come to the part that's more applicable for everyone, and what also Picuna's main service is doing, so crypto tax reporting. Crypto tax reporting, what is it? So it's the path to get from the transaction on-chain or on exchange to a profit and loss report. This comes with more hurdles than it should. Why is it necessary? It's necessary because usually, or in almost all other areas that we as like private people have to do, our taxes are calculated by someone else and oftentimes even paid by or already withheld from someone else. If you have an income, if you're employed, then your employer will calculate your income tax and withhold it. If you're trading with a stock or something, your bank will calculate your profits and withhold the needed income tax. So in crypto, there is no central entity that could do that for us. Therefore, there is a very fast way to get into not being compliant with tax law, because you have to take care for everything for yourself. It's completely new that you really need to keep track of transactions. No other legal tax area where we have to do that as a private person. For businesses, it's something else. They're used to that. But as a private person, that's something different. So the difference between the reporting and the filing part is the reporting means creating these probably really long reports of all the transactions, calculating all the profit and losses. Filing is taking that one final number, put it into the tax declaration, and send that to the tax office. That's usually the first contact point the tax office has. At this point, there is even special fields in the income tax declaration that only ask about, did you have income related to cryptocurrencies? So they are very well aware of what's happening and want to be able to track that in the future, to monitor how much income is reported, and to really be able to pretty fast filter on these kind of information. And that's necessary for the tax office because they're at the moment gathering data. So if you say, so far I haven't gotten caught, yeah, I believe that. There is not a lot going on right now where they're actively reaching out to people. But that is changing very quickly and probably very soon. I would say you can probably get away with it the next year or two. But the first thing they did is, for example, if you ever were registered on Bitcoin.de, they got all the registration, or a big bunch of registration and trading data from Bitcoin.de. There's the new regulation, MiCA, CARV, the travel rule. There's a lot more in the making, already decided, coming up, that all leads to, okay, the exchanges need to gather these data. They need to do AML, they need to do KYC. They need to do a lot of things to be able to identify you, to later report to authorities and to match you. I'm part of a working group on international tax data exchange. So the German government is working how to exchange these tax relevant crypto transaction data that they get from exchanges that are based in Germany with other countries. So the law is already there, so that is coming for sure. It's just a matter of how they do it and how detailed they're doing. They want to do something on transaction basis where we say that's absolutely insane. They're not aware of what's coming to them. If they really want to exchange data transaction by transaction with all other states, and so it's just a matter of time. So now we come to compliance. Why are we talking even about compliance? Means how am I working on being correct with whatever I'm doing to match what the law is saying. Doesn't mean it's perfect, but it's like I need to make sure to try to be as good as possible, and also to often write down my whole processes and how I'm doing with taxes and transaction monitoring. This is something that's also completely new to private users. That's something that we've never had here before. Companies have to do that. They have to write like how they're trying to be as tax compliant as possible. Compliance for private users was not a topic ever. Like, okay, you need to save your receipts for a certain amount, but that's basically it. And there is not a lot of compliance one private person has to do. Different for crypto, the compliance requests are quite high here. And also the cooperation duties private users have to do. Cooperation means how do you have to cooperate with the tax office. Tax office has questions, do you have to answer them? What can they do if you're not answering them? Can you refuse to give them information? There is currently a discussion going on where we're trying to determine if a blockchain is based within the country or outside the country. So you can see how ridiculous that question is, but that's really important for them to figure out, because based on that we either have the normal compliance or like a extended or normal cooperation or an extended cooperation rule. For everything that's based within the country, the state has its own methods to gather information. For example, trading on a German bank, the German bank will tell the tax office information anyways. So within the country it's a lot easier for them to get information. Blockchain, we argue that we have nodes running for every major blockchain in Germany, therefore it's based in Germany. Tax office, you can get your own information, it's publicly available. Tax office says, yeah, but we don't have anyone to reach out to give us this information. Therefore, it's not based in Germany, and most of the companies behind, or foundations, behind the blockchains that are running them are somewhere else. And taking a short break. Okay, we're all safe, and it was very much like I predicted, so, or when like the news said it should happen. That was not always the case. I remember a couple of years where it didn't work at all, and last year I think it was heavily delayed, and between different service providers they also had, it was like ringing for 10 minutes in my co-working space because one E+ sent them earlier and Telecom later, but I think we're pretty good at this point. So, what are we doing to solve these problems that I just mentioned? Compliance and reporting. Usually we use crypto tax tool. There is basically no regulation on how you have to do it. The Excel sheet is just fine as well. A lot of people still use Excel, but at this point I think it's getting more and more complicated, and especially with a lot of, if you're doing anything in the DeFi world, in staking, in then it's getting very hard to track all your transactions, and the tools that are on the market oftentimes give you quite good ways to import your data directly, to just add your wallet address, to add your exchange API keys. But if you ever worked with one of those tools, you will see it's not that straightforward, unfortunately, and we're still dealing with another couple problems that sometimes the tools can't even solve. We are dealing with missing data. Missing data can occur, for example, from exchanges that are not anymore here. Exchanges that have bad data tracking, that's also a thing. Also from blockchain upgrades. We have some blockchains that just have complete upgrades which are losing sometimes history. Also that can happen. There is, for example, taxes also not always can provide the full history of data. So therefore, missing data is actually a real problem. What you can do here is restructure data, take everything you know, fill in the gaps as best as you can, tell the tax office you recreated this data based on this and this information. and try to fill out the gaps. What's the problem if you have gaps in your reporting? You can be like, oh, it's not that bad, I'm missing a couple of transactions, missing an exchange, but I haven't done a lot on this exchange. You're losing, you're breaking your first in, first out chains. So as I mentioned earlier, you need to track from your purchase till your selling. And oftentimes in crypto, we are not buying, holding on one exchange and selling. We are buying, moving it to a wallet, moving it to cold storage, moving it into a DeFi protocol, moving it to another exchange, swapping against another coin. And to find these chains with all its in-between steps, we need to match all deposits and withdrawals, and we need to have them all. The problem is if you lose assets in between, it's hard to argue that we've held them for more than a year. Also, if we don't have the data complete, it could be that other data that's missing in between, because we always take the oldest one, is messing up our first in, first out order. If there's a block just missing, then we're now taking something that's not the oldest not the oldest asset on our wallet, but something younger, and later when we fix the error, we suddenly change previous years and other calculations again. So that's a very big problem. Incomplete data, another thing, often from exchanges, historical data, on-chain DeFi protocols that don't provide all the data, or even the wrong data. That's also something that's more common than you might think. That starts with easy things like timestamps are not correctly, so they might be in UTC or in a local time zone, whatever they are using. Also, a very common one is that the three-letter things to identify the token are not always the same. They're sometimes reused. They're sometimes used differently on different exchange. So suddenly we match up different assets with each other and mix them up. We have a lot of spam token. If you've ever got on usually Polygon or some low fee blockchain, 1 million USDT, it's not the real USDT, but it still messes up your first in, first out, or if you have actual proper USDT on that wallet, because the crypto tax tools usually don't account for that. They're not looking at the wallet address, they just take the 3-digit number. And yeah, thank you very much. So here, that's a slide to take a picture of, so you have all my contact information. And happy to stay in contact. I'm especially active on Instagram, on the Bikuna channel, but also on my private channel. We share regularly of what we're experiencing in the crypto tax field, and also if there's any news, if we're talking to regulators, if anything changes or might change, or if we're in discussions with politicians, ministries, and so on. So thank you very much.
Since we finished ahead of schedule, actually, we do have about 3 or 4 minutes for questions if you're willing to take it.
Yes, absolutely. I love questions.
So if anyone has questions, please.
Don't be mad if I put down your question. I think you were first, because they might be too specific for everyone to be interested in, but go ahead.
Yes, thank you for the information, very good. And there are quite some tools already in the market, for example, Coinme or individual exchanges also offer their tools like crypto.com. What I have been doing is that I put all the information into the tool and then generate this very comprehensive report and then send it together to my tax supervisor. And so based on the information I got, it's very comprehensive, so that didn't break the first in, first out route. So how reliable are these tools? And especially Coinme, for example.
I actually have a whole presentation just about the reporting part, and that's also where I copied out those slides. And I was thinking of taking that one slide where I talk about the exchange reports, because they're often used. And for me, there's a couple problems. They give a false sense of security. They look very official, and they're provided to you from your exchange. Exchanges are not experts in taxes, and they don't have to be. So these might be country-specific. Most of the time, they're US-based. Most of the rules you can use, and if you have nothing else, then it's better than nothing. Second problem is they're a silo. They're only looking at what happened at their exchange. If you never have any deposit and withdrawals, that's good enough. Or if you can combine multiple exchange reports to one, and you don't have any transactions between those, you're also good. But as soon as you're starting moving assets in and out, these reports are failing and they're not always telling you. I've seen reports that look very official, that have like a final number, everything seemed reasonable, but then when I went into details, I was like, oh, there's like deposits. What did they use as a cost basis for the deposits? And the exchange used the value at the time the deposit was made. So they're assuming that you purchased them right at that time somewhere else and moved them over, which could be true, but it's probably not. And therefore, I would always be a little careful with these kind of reports. But yeah, thanks for pointing it out.
This report did got challenged by the financial, so there's some kind of but that too is actually comprised of all the exchanges rather than just one. And also include the blockchain record, you can give the Ethereum address.
Some of them have like more modern features where you can also add other data sources as well. Then they're a little bit more sophisticated, but I think still the problem stays a little bit the same. So rather go to like a dedicated crypto tax tool. You mentioned coin leaders, coin tracking, Blockpage. There's a whole bunch of them. I think all of them are doing kind of a good job. None of them is perfect. Yeah. You have a question, yeah.
So at the beginning you had these buckets on
Yep.
the slides. One bucket was like income, one other was staking. So they are like projects like I think of Pendle. They you pay you're getting the staking already upfront and buying the stock. Yeah? So it kind of looks like you can shift one bucket to the income bucket. Are you familiar with this kind of protocols? Can you say something?
I'm using a simple. They're not letting go. I'm using a simpler example. Is it STEs or wrapped STEs? One of them accumulates assets directly. I think it's wrapped STEs that directly accumulates the staking income into the token, and that's actually correct. You can therefore move staking income into your trading income. So yeah, that is something that is possible and that people intentionally do for that purpose.
So I think that's all for the time we had, unfortunately. But feel free if you have time afterwards.
Yes, I'll be here today and tomorrow all day. Feel free to reach out.
Perfect. Thank you very much. A very interesting talk.
Thank you.